CME's official reason for the halt was technical issues. Natural gas, which was also halted, reopened at 12:50, just 35 minutes after the freeze began. Metals didn't reopen until 1:45 p.m. That's 90 to 100 minutes of frozen markets, where metals traders had zero access to their positions. No buying, no selling, no price discovery. Just locked while every other market on Earth kept moving. Let's be precise about what a trading halt actually means in practice. When CME freezes a futures market, traders cannot enter new positions, cannot exit existing ones, and cannot adjust stops. If you were long silver going into 12:15 Central, you were stuck. You couldn't cut your position if you wanted to. You couldn't add to it. You had no control over your own capital for 100 minutes. That's not a minor inconvenience. For leveraged traders managing risk in real time, 100 minutes of zero access is a significant and consequential window. Now here's the detail that separated the informed from the uninformed in the hours that followed. When CME halted trading, they canceled all-day orders and good-till-date orders. Only good-till canceled orders that had already been acknowledged stayed in the system. Read that again carefully, because the mechanics here matter more than the headline. Every trader who had placed a buy order to catch a dip, gone. Every limit order sitting above the market waiting to sell into strength, gone. Every stop buy order positioned to catch the $92 breakout, gone. The entire architecture of queued retail intention was erased in a single administrative decision. The order book that had been building momentum toward $92 was gone. The structural buying pressure that had accumulated was wiped. Institutional players who could react instantly the moment markets reopened had a clean slate to work with. This is not speculation about motive. This is a mechanical description of what the order book cancellation produced. A retail trader sitting at home trying to understand why their platform showed no open orders needed time to log back in, time to re-enter positions, time to process what had happened and rebuild their queue. A trading desk with direct market access and pre-programmed responses needed seconds. The asymmetry is structural. It isn't about conspiracy. It's about who has the infrastructure to respond at machine speed versus who needs to manually re-engage. When an order book resets, the players who repopulate it first set the new tone. And when trading resumed, the selling was immediate and coordinated enough to drive price down $3 in minutes. That $3 move deserves its own examination. A $3 drop in silver in minutes is not a retail-driven move. Retail traders were still figuring out what happened. They were reading news headlines, checking their accounts, calling brokers. The volume and velocity required to push silver from $91 to $88 in the opening minutes of resumed trading reflects institutional scale selling that was either pre-positioned or executed at machine speed the moment the market opened. No bounce, no hesitation, just pure selling pressure the moment the gates opened. Organic selling from a distributed retail base doesn't produce that price signature. Silver was approaching $92 before the halt. That level had been identified in previous analysis as the next significant target. Price had already broken through $89, held it as support, and was building toward $92. The momentum structure was intact. Open interest was elevated. The Shanghai premium was persistent. Every technical and fundamental input was pointing toward a test of $92. Then the halt happened right as price was testing that threshold. Timing is data. When a market halt occurs at the exact moment price is approaching a level that would trigger forced covering from concentrated short positions, the timing itself becomes part of the analysis. It doesn't prove intent, but it is a fact that sits alongside every other fact in this picture and demands an honest examination. Now consider the two explanations side by side with clear eyes. CME runs extraordinarily complex infrastructure. Trading halts do occur on major exchanges. Natural gas reopened in 35 minutes, which suggests the core systems came back relatively quickly. The argument that metals required additional verification checks before reopening is plausible on its face. Stop-loss cascades and leveraged liquidation are real phenomena that can produce sharp moves on market reopening. Traders who were stuck in positions and desperate to exit the moment they could would create selling pressure, regardless of any other factor. That is a complete and internally consistent explanation. It requires no coordination, no intent, and no actors beyond normal market mechanics. The second explanation sits on this foundation. This is the second major CME disruption this month. First week of February, settlement prices were delayed. Now, a full trading halt. Half a decade without outages, then 2 and 3 weeks. The halt occurred 48 hours before March 1st notice day, one of the most consequential settlement windows in the current delivery cycle. Silver was at the precise technical level, where a breakout would have accelerated, covering pressure on short positions. The order book reset disproportionately disadvantaged the participants who were building that momentum. And the price action on reopening was immediate, directional, and sufficient in scale to invalidate the technical setup entirely. Both explanations are on the table. The data is what it is. Pull the vault reports. Verify the February gold anomaly. Check the Shanghai premium. The facts don't require editorial framing to be significant. They are significant on their own terms. What is not debatable is the outcome. Silver halted at $91.30. Markets froze for 100 minutes. Trading resumed with an immediate $3 drop to $88. Price is now at $89.20, holding former resistance as support. The momentum that was building toward $92 is gone. The order book that carried that momentum was canceled by administrative decision. And the delivery pressure that existed before the halt, declining registered inventory, persistent Shanghai premium, elevated open interest approaching settlement, hasn't resolved. This is the second major CME disruption this month. In the first week of February, settlement prices were delayed across metals markets. Now a full trading halt, 90 to 100 minutes of frozen price discovery, at one of the most critical points in the delivery calendar. Half a decade without outages, then 2 in 3 weeks. That frequency shift is not a footnote, it is the story. To understand why the pattern matters, you have to understand what settlement price delays actually mean in the context of a futures market. Settlement prices are the official closing prices used to calculate daily profit and loss, margin requirements, and delivery obligations. When those prices are delayed, margin calls get delayed. Position valuations get frozen. The administrative machinery of the market stalls at precisely the moment traders need clarity. In the first week of February, silver was building momentum toward key resistance levels when those settlement prices were delayed. The disruption wasn't catastrophic, but it was enough to interrupt the structural pressure that had been accumulating. Then came Wednesday's halt. A full freeze. Not a delay, a complete stop. And again, silver was building momentum toward a key resistance level. Both times, the disruption occurred when silver was approaching price levels that would have triggered significant technical breakouts. Ask yourself a simple question. In the half-decade before these two disruptions, when were the exchanges running smoothly? When silver was falling? When gold was drifting sideways? When metals were quiet and institutional short positions were comfortable? Funny how these technical issues never occur when prices are falling. That observation isn't analysis, it's arithmetic. You either believe the timing is coincidental across two separate disruptions in 3 weeks, or you factor the timing into your assessment of what's happening. Jesse Livermore wrote in Reminiscences of a Stock Operator, "When you control the exchange, you control when trading happens and when it doesn't." Livermore was writing about early 20th century market mechanics, but the principle is timeless. The entity that controls market infrastructure controls the conditions under which price discovery occurs. A well-timed halt can accomplish what direct manipulation cannot, resetting momentum when price pressure builds beyond containment. You don't need to place a single visible trade. You just need the market to stop at the right moment. And when it restarts, the setup that existed before is gone. This isn't a fringe interpretation. It's the logical extension of understanding how market structure works at an institutional level. When you control the exchange, you control when trading happens and when it doesn't. The order book cancellation that accompanied Wednesday's halt reset the technical structure that had been building. The momentum was gone. The queued positions were gone. The $92 breakout setup was gone. And it was accomplished without a single, visible intervention in price. Now shift the view to Shanghai, because the Eastern markets are telling a completely different story than the narrative being constructed in the West. Shanghai spot was trading at $101, SHIFT futures at $106, Western spot at $89. That is a $12 premium on spot, $17 if you compare Shanghai futures to Western spot price. These numbers are not abstractions. They represent the price that physical silver is actually changing hands for in the world's largest physical demand market, versus the price being set by paper contracts in New York. Physical demand in Asia versus paper pricing in the West. When markets are functioning normally, arbitrage mechanisms keep these prices relatively aligned. Traders buy physical in the West and ship it east to capture the spread, and the gap closes. The fact that this gap is $12 to $17 and persistent, not closing despite the obvious arbitrage opportunity, tells you something specific. Either the physical metal available for arbitrage is insufficient to close the gap, or the friction costs of moving metal from west to east have become prohibitive, or both. Either explanation points to the same underlying reality: physical supply is tighter than Western paper prices are reflecting. When that gap persists and widens during Western market dislocations, it signals something deeper than temporary arbitrage. The dislocation on Wednesday, a $3 drop in Western spot on market reopening, did not narrow the Shanghai premium. If anything, it widened it. Western paper price went down while Shanghai physical stayed elevated. That divergence is data. And Shanghai was not a passive observer this month. The Shanghai Futures Exchange suspended 25 trading groups in February for violating position limits. 25 in a single month. That is an extraordinary enforcement action by any measure. Position limit violations on a futures exchange mean traders were accumulating concentrated positions beyond what the exchange rules permit. Exchanges act when concentrated positioning creates systemic risk. The chef doesn't suspend 25 trading groups in a month because markets are calm and orderly. They do it because something in the positioning structure was creating a risk they needed to contain. Now hold all of this together simultaneously. Two CME disruptions in 3 weeks, both occurring when silver was approaching resistance. A persistent $12 to $17 premium between Shanghai physical and Western paper prices. 25 SHAFE account suspensions in February for position limit violations. These are 3 separate data points from 3 separate market structures on 2 continents. When you see 25 suspensions in 1 month plus a persistent $12 premium, while Western markets experience trading halts, these data points aren't isolated. They're connected. The connection isn't speculative. It runs through the same underlying reality. Physical silver demand, particularly in Asia, is creating pressure on a system that prices silver primarily through paper contracts in Western futures markets. When that pressure builds to the point where it threatens to force visible delivery failures or dramatic price movements, the response appears in multiple places at once. Enforcement actions in Shanghai, trading halts in New York, persistent premiums that arbitrage cannot close. This is what a structural dislocation looks like before it becomes visible in headline prices. It doesn't announce itself. It shows up in vault withdrawal data, in Shanghai premiums, in enforcement actions, and in the timing of trading halts. The majority won't check, because checking means facing uncomfortable truths. They'd rather dismiss than verify. The ones who actually look at the data, they don't need convincing. The pattern is not a theory. It is a sequence of documented, verifiable events with timestamps, vault numbers, and exchange records attached to every single data point. Pull them yourself. Section 3. The vault data, the gold anomaly, and the November precedent. Pull the COMEX vault reports. Not the headlines, not the summaries. The actual daily warehouse reports that CME publishes and that almost nobody reads. Because what those numbers show right now is a physical silver inventory in structural decline. And the rate of that decline is accelerating at precisely the moment delivery obligations are peaking. COMEX registered silver fell 2.2 million ounces on Tuesday alone. To understand why that single number matters, you need to understand the difference between registered and eligible inventory. Eligible silver is metal that meets COMEX quality and storage standards, but has not been designated for delivery against futures contracts. Registered silver is metal that has been specifically designated. It is the inventory that can actually be used to settle a futures contract when a buyer demands physical delivery. Eligible inventory exists, but it's not designated for delivery. That distinction matters because the structural deficit continues beyond March. When registered inventory falls, the pool of metal available to satisfy delivery demands shrinks. When it falls 2.2 million ounces in a single day, that is not routine inventory management. That is significant, directional withdrawal at a moment when March delivery obligations are 48 hours from their first notice date. Total registered now sits at 86.3 million ounces. Here's the breakdown of Tuesday's withdrawals by vault. 155,000 ounces withdrawn from Asahi. 167,000 adjusted out of Brinks registered. 647,000 withdrawn from HSBC. 374,000 withdrawn from JP Morgan. 80,000 withdrawn from Stonex. Some metal moved into Loomis registered, but the net result was 890,000 ounces out of registered in a single day. These are not rounding errors. These are specific, named institutions removing specific quantities of designated delivery metal from the system on the same day. When withdrawals are this distributed across multiple vaults simultaneously, it reflects multiple separate parties making independent decisions to pull their metal out of the registered pool. That is a different signal than a single vault showing an adjustment. Every day, the number declines. And what is categorically not showing up in these reports is new metal flowing into COMEX vaults to replenish what's leaving. The one-way direction of this flow is the data point that matters most. What's not showing up is new metal flowing into COMEX vaults to replenish what's leaving. Yesterday's 71 million ounce roll was the largest on record and relieved immediate March pressure by moving contracts forward into May and July. But the roll is a deferral, not a resolution. The roll happened, yet registered silver keeps falling. Physical continues leaving the system. Shanghai premium isn't collapsing, despite Western paper price getting hit. Rolling contracts forward doesn't put physical metal back into registered vaults. It moves the delivery obligation to a future date, while the underlying inventory continues declining. The structural deficit doesn't care about the calendar. It persists regardless of which month the contracts are dated. Now here's the anomaly that almost nobody is talking about, and it sits directly alongside the silver vault data, as evidence of the same underlying stress. The February gold contract still shows 4,000 contracts open. That's 12 tons worth $2 billion at current prices. The February gold contract is not a current contract. It is a contract whose delivery window should be closed, or nearly closed. Contracts opened at the start of February should have been delivered or rolled by now. They weren't. One party still needs to deliver 12 tons against February contracts this late in the month. That's not normal settlement behavior. Normal settlement behavior means contracts are either rolled before first notice day, or delivery is completed within the standard window. 4,000 contracts still open at this stage of the month means someone is either unable to deliver, unwilling to deliver, or negotiating terms that haven't yet been resolved. Any of those three possibilities reflects stress in the delivery system. $2 billion worth of unresolved February gold delivery obligation, sitting open, while COMEX silver registered inventory declines daily, and March 1st notice day is 48 hours away. These are not separate stories. They are the same story told in two different metals. This brings us to the November precedent, because the current setup has a direct historical parallel that the data maps onto with uncomfortable precision. On November 28th, CME halted silver trading for 10 hours. The official reason given was cooling issues in the data center. Silver was trading at $53.26 when the halt began. That halt happened on first notice day for December silver, the same critical settlement window that Wednesday's halt preceded by 48 hours in the current cycle. Reports emerged that a Chinese industrialist had notified COMEX of intent to take physical delivery of 30 million ounces. That is a delivery demand of extraordinary scale against a registered inventory that was already under pressure. When trading resumed after those 10 hours, silver spiked to $56.78. The delivery pressure that had prompted the halt didn't disappear because the market was closed for a morning. It was still there when trading resumed, and price reflected it immediately. Then, over the following 60 days, silver moved from $53.26 to $121, a 2.5x move. Not because the halt itself was bullish. The halt was not the cause. The cooling issues occurred exactly when delivery pressure peaked. The halt was the symptom. Physical shortage was the cause. When that pressure couldn't be contained through normal market mechanics, extraordinary measures became necessary. Then when trading resumed and delivery pressure persisted, the move accelerated. The pattern is consistent. Trading halts cluster around settlement periods when delivery obligations are highest, and price is testing resistance that would accelerate covering pressure on concentrated short positions. Wednesday's halt fits that exact pattern. 48 hours before settlement, silver approaching $92, registered inventory declining daily, Shanghai premium persistent. The COMEX open interest declining while SLV sees new inflows daily completes the picture. That's de-risk behavior. Capital is rotating out of futures exposure and into physical-backed ADF exposure. You don't abandon the futures market for ETF premium unless you're worried about counterparty performance. This isn't retail sentiment. This is institutional positioning that reflects a specific concern that the entity on the other side of a COMEX futures contract may not be able to perform delivery when demanded. When that concern becomes widespread enough to move capital flows visibly, it shows up exactly as it is showing up now. COMEX open interest falling, SLV inflows rising, registered vault inventory declining, Shanghai premium persistent. The ones who actually look at the data, they don't need convincing. Every number in this section is verifiable. Every vault withdrawal is in the published warehouse report. The February gold open interest is in the CME commitment of traders' data. The November precedent is in the historical price record. This is financial warfare education, not investment advice. Invest with logic, not hype.